Today, the market takes another dose of hopium. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. So on Monday, US equity markets rose and the dollar slid, driven by the idea that China might ease COVID restrictions and the prospects of a GOP rise in the midterms, and hopes the US economy is slowing enough to allow the Federal Reserve to ease its aggressive hiking of interest rates. While the divided Congress is typically viewed as good for the markets, the hope the US economy is losing enough momentum for the Fed to slow the pace of monetary tightening did push the dollar lower, said Joe Manimbo, senior market analyst at Convera in Washington. The market is really desperate for the Fed to pivot, he said. It will take anything it can in terms of signs of a softening economy to hold out hope that a pivot might materialize sooner rather than later. The relatively strong US jobs report from last week ensured the Fed will be in no rush to ease policy, though the pace of rate hikes may slow as the US central bank keeps rates higher for longer, a view that pressurized Treasury yields higher. Slowing inflation on the heels of signs of Friday's US employment report for October, showing that the labour market is cooling, would be positive for risk appetite and negative, at least over the short term, for the dollar, Manimbo said. And as a result, the markets looked past both data showing Chinese exports and imports unexpectedly contracted in October as China grappled with COVID-19 curbs, and the prospect that the US Consumer Price Index, which is out on Thursday in US time, will show inflation remaining high. Median forecasts call for an annual US inflation to slow to 8% and for the core to dip to around 6.5%. Stephanie Elko, strategist at Tradition in London, said the market is looking for an excuse to buy stocks. In spite of China sticking to its zero COVID pledge, there are some in the market that still believe that China might somewhat ease its COVID-19 policy, she said. What might or might not happen with the election is not that big of an influence on the market. The big influences are the Fed and what's happening in Ukraine and Russia. Tim Grinsky, Chief Investment Strategist at Investors Council in New York, said. The major indices in Europe mostly closed higher, with the exception of the FTSE in London, while Wall Street rallied in late trading after a choppy early session. The MSCI's All-Country World Index gained 1.14% and the broad Pan-European Stoxx 600 Index rose 0.33%. On Wall Street, the Dow Jones Industrial Average rose 1.31%, the S&P 500 gained 0.96% and the Nasdaq advanced 0.85%. Meta Platforms jumped more than 6% to lead big tech higher, as the social media giant is reportedly eyeing mass layoffs that could be announced this week, easing investor worries about spiralling costs amid the firm's plan to keep investing in virtual and augmented reality amid a push into the metaverse. And the volatility index slipped back to 24.35. A more than 2% climb in Microsoft Corporation and Alphabet also supported sentiment on tech, while Apple cut losses to end positive despite warning on lower iPhone production. Apple temporarily halted production of the iPhone 14, blaming COVID-19 restrictions in China. The news triggered worries about iPhone demand, but some analysts pushed back, saying that demand remains strong. While not the news any bulls want to hear from Apple, it's a supply issue and related to China's zero COVID policy, which is a very frustrating situation for Apple and its investors, yet again, but not demand-driven, Wedbush said in the note. Energy also played a role in the broader market climb, even as oil prices struggled amid mixed signals about whether China is set to ease its strict COVID-19 restrictions. EQT, Baker Hughes and Schlumberger led the gains in the energy sector. The earnings front offered a mixed outlook on corporate American. Palantir Technologies reported mixed third-quarter results as earnings missed, but revenue beat expectations, sending its shares down 11%. And Warren Buffett's Berkshire Hathaway ended the day more than 1% higher after reporting that profit rose by a fifth, led by strength in its insurance holdings. The conglomerate also upsized its share buyback program and raised its dividend. In other news, The rout in Convera continued, falling more than 50% following the used car sellers' quarterly earnings miss last week that led to negative reaction from Wall Street. The dollar index was down a further 0.6% to 110.21, while the euro rose 0.61% to $1.0018, and the Japanese yen strengthened just a little against the dollar at 146.64. The dollar was also under pressure as traders held on to speculation that China could temper some of its COVID restrictions after the government on Monday indicated it will make it easier for people to enter and exit the capital. The yield on the 2-year notes, which typically moves in step with rate expectations, rose 1.63% to 4.7280, while the 10-year yield was up 6 basis points to 4.218%. A closely watched part of the yield curve, measuring the spread between the yield on the 2 and the 10-year notes, seen as a recession harbinger when the short end is higher than the long end, was deeply inverted at more than 50 basis points. Gold prices steadied near a 3-week peak on Friday, buoyed by a weaker dollar as investors awaited the CPI report that could influence the Fed's interest rate policy. It was last at 1,677.45 in the futures market. Bitcoin fell more than 3% to 20,495. Oil prices fell on Monday, pairing gains after rising to more than a 2-month high on mixed signals over China, the world's top crude importer, potentially relaxing its strict COVID-19 restrictions. Brent crude futures fell 65 cents to settle at $97.94 a barrel, but earlier in the session, they rose to a session high of $99.56 a barrel. That's the highest since August the 31st. And US West Texas Intermediate crude dropped to $92.08, but earlier it rose 74 cents to a session high of $93.74 a barrel. That's the highest since August the 30th. Prices climbed during the session on news that Chinese leaders are considering reopening the economy from strict COVID-19 restrictions, but are proceeding slowly and have set no timeline, according to the Wall Street Journal. The market seems to be thinking that if China opens the economy, that would tighten supply significantly and put further upward pressure on prices, said Phil Flynn, an analyst at Price Futures Group. However, weighing on futures, Chinese health officials at the weekend reiterated their commitment to strict COVID containment measures. Meanwhile, China's imports and exports contracted unexpectedly in October, but its crude oil imports rebounded to the highest level since May. And oil prices may have also been underpinned by expectations of tighter supplies when the European Union's embargo on Russia's seaborne crude exports starts on December the 5th, even though refineries worldwide are ramping up output. For a lot of folks, it looks like there is going to be a scramble for barrels come December, in particular in the Eurozone, said Bob Yoga, Director of Energy Futures at Mizuho in New York. US oil refiners this quarter will run their plant at breakneck rates, near or above 90% of capacity. China's largest private refiner, Xinjiang Petroleum and Chemical Co., meanwhile, is raising diesel output. So my point here is this, that once again, the markets are desperately seeking hope, looking everywhere and anywhere for signs that things are going to get better. The example of China and its COVID lockdowns, and whether they're going to ease them or not, as well as, of course, the expectation with regard to the Fed and whether it will pivot or not, are just two examples. The market is pretty illogical at the moment, and, of course, Hopium rules. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.